Hey everyone, welcome to another episode of ADMAIL. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Everyone, and welcome to another episode of ADMAIL. I'm Adam Bergman, tax attorney and founder of IRA Financial. On today's episode, we're going to be tackling a solo 401k question about adding a spouse, paying quarterly fees for a self-directed IRA. It's the best way of doing that. And if you are married, file jointly, can you each set up IRA? So 3 really good questions on today's podcast. And without further ado, let's get right to it. First question is from Rick P. of San Diego, California. And Rick wants to know, I have a solo 401k plan for a sole proprietorship business and now want to set up a plan for my wife. Can I add her to my plan? So when it comes to setting up a solo 401k plan, Rick, there's a couple of rules to keep in mind. Obviously, your spouse needs to have a self-employment business. So there has to be a business with no full-time employees other than the owners, their spouses, and anyone that works less than 1,000 hours for the company or 500 hours 3 consecutive years. So you can't have any non-owners that work more than 1,000 hours, essentially. So you have a couple options here. You have a sole proprietorship. So if you want to add your spouse to your business plan, you can, but you'd have to pay your spouse a W-2 through your sole proprietorship. You can't make her an owner because sole proprietorship means one owner, but you can pay her a W-2. So if you have an accounting firm, you want to pay her to do some marketing work or some other work, that's possible. But if she's in a totally different field, let's say she's a math tutor and you're an accountant, or she's an architect and you're an accountant, she's going to need to set up her own plan because she's going to need a separate business to adopt the plan because she's not going to be associated with your business. But if you're able to hire her through your business, then you don't need a new plan for your spouse and she can just be part of your solo plan through the sole proprietor, but she needs a W-2, not a 1099. If that's just not possible, then she'll need her own plan. But let us know. We spoke about this, Rick, I don't know, a couple weeks ago. So we're around if you need help. But yeah, she's going to need her own plan because she has a separate business. So thank you for that question, Rick. The next question is from Instagram. And this individual wants to know, I need to pay my quarterly self-directed IRA custodian fees. Can I make a contribution and use those funds to pay the fees? The answer is yeah. Now, there's a caveat. You need to be eligible to make IRA contributions. So obviously, you need income. If you have no income, you're retired on Social Security, you can't obviously do an IRA. Now, you could piggyback off a spouse. So if you're retired but your spouse works, then you can still do an IRA, assuming they have enough income. Now, generally, there are rules in terms of income limitations for pre-tax IRAs. So if you have access to a 401k at work and you make above a certain threshold, you may not be able to make pre-tax IRA contributions. Okay. Now, generally in 2022, if you are married, filed jointly, it's about 100 and it differs. It's 129,000 if you are married, filed jointly, and you're covered by a plan, and it's 214,000 if your spouse is covered by a plan. So if you're covered by a plan and you make more than 129, you can't do a pre-tax IRA. If you are married and your spouse is covered by a plan and you're not, then you can't have more than 214,000 married, filed jointly to do pre-tax IRA. If you don't satisfy those requirements, you can always do a Roth IRA. Roth IRAs have an income limitation of 214,000, but because of the backdoor Roth IRA rules, even if you make $100 million a year, you can just do an after-tax IRA and convert it to Roth. Why does that make sense? Because you can then use those contributions, potentially even get a tax deduction if you're eligible for a pre-tax IRA, and pay your IRA custodian fees versus paying a credit card or through personal funds. So some people say, hey, I'll just get a deduction. I'll put the $500 in the account for the year. I'll get a deduction and I'll use those fees to pay the IRA custodian fees. Some will say, now just pay a credit card. I don't care about a $500 deduction. It's not worth my time. Or if you aren't eligible for a pre-tax IRA deduction because you make too much money, then a Roth IRA is after tax, and you might as well just use personal funds. So very good question. I think the answer comes down to if you can get a pre-tax deduction for the traditional IRA contribution, then make the contribution, get the deduction, and have those fees go towards paying the IRA custodian fees. So thank you very much for that really good question. And third and final question on today's podcast from YouTube. When someone files taxes as married filed jointly, can each spouse still have their own IRA? The answer is thankfully yes. So if you are married filed jointly, IRAs are still individual based. Now, yes, they're essentially allocated based off a joint income. So you can make 100,000, your spouse can make zero. You're both paying tax on 100,000 if you're married, filed jointly. So you both can still make $6,000 or $7,000 IRA contributions because all the income is aggregated. But each of you can make the contribution. It's an individual IRA. Even if you pay tax as a married couple and your income is aggregated, the contributions are individualized for each spouse. So to answer your question, yes, so long as you have more than enough to put the contribution. Each max is 6,000 if you're under 50, so 12 for a spouse, a married couple, or 14, 7 plus 7 if you're over 50. So as long as you technically have, $20,000 or so, you can max out the 7 and 7 or the 6 and 6. Why put a little bit more? Because there's always Social Security taxes that need to come off your net income. So it's a little bit less than the amount you earn. And there's also deductions because generally, depending if you're Schedule C, it's maybe your net amount. W-2 is more on a payroll number minus Social Security and other related taxes. So to answer your question, yes, if you're married, filed jointly, so long as you have enough income, you can still do IRA or Roth IRA individually, 6 and 6 or 7 and 7. That's the max. Obviously, you don't have to put anything in an IRA if you don't want to, but you're entitled to individually, even though you pay tax on the aggregate as a joint family or joint spousal return. So thank you for that question from YouTube. And there is another ADMAIL in the bag. Thank you very much for listening. If you're watching on YouTube, appreciate it. Thanks again for all your support. This is a weekly podcast that drops every Thursday. So don't forget to catch us again next Thursday for 3 more amazing questions from clients, non-clients, just smart people around the country that are interested in various self-directed retirement topics. So thanks again for spending some time with me today. Have a great day and take care.